días a todos, bienvenidos. Vamos a dar comienzo a este acto que teníamos previsto a las 12, que va a desarrollarse en inglés y bueno, pues vamos a cambiar a hablar en inglés, ¿no? Welcome to everybody here. It's a pleasure of having here Neil Atkinson. He is responsible for this oil medium-term report of the Energy Agency, and as you all know, we presented this year the two of these medium-term reports, the Renewables Energy Report and the Coal Report, as we did many years, and this is the time for the club to present the oil report here. No, in this year they will have they'll put out another report from gas. We will try to present either, and this is a pleasure for us to having here Neil Atkinson. I try to present him now to do this job and to present the oil report. This presentation will be on our web, and you can download from after this event. Mr. Neil Atkinson, he joined the IEA, I think this year in January, but before he has been working around in the oil sector since 1980s. He has been working he worked in PDVSA. He works as a contributor in several companies, several consulting companies, and now he joined the IEA from 2016. He is responsible for this medium-term report of oil. There are many questions you can ask him about the oil situation, the markets, the OPEC strategy, the Saudi Arabia strategy. We are going to present in 40 minutes the report, and after this you can do a Q&A section. You can ask him whatever. He is open to answer whatever you could ask him. Okay, Neil, it's your floor. Please.
Okay.
Go ahead.
Thank you very much. Market report. Thank you very much. I don't normally even need a microphone, but it's even better. Thank you. The medium-term report was published in February of this year, and for those of you who aren't familiar with it, this is a copy of a 122-page document which attempts to look at some of the key issues in oil over the next 5 years out to 2021. And when I joined the agency in January, on Monday, January the 11th in Paris, we were looking at yet another extremely turbulent period in the oil market. The oil price had fallen just before Christmas down to $40 a barrel, and by the later part of January, the price went down to $30 a barrel, and at one point slightly below that. And so it was a period of great turbulence, of great uncertainty. At that time I started working with my team on producing this report. Some of the investment banks were forecasting that the oil price would fall to $20 a barrel. There was even one forecast that the price could even go down as low as 10. So we were looking at an extremely volatile and turbulent situation. And what has made producing this report even more interesting than it would ordinarily be is the fact that at the end of last year, at its meeting in December, OPEC essentially formally abandoned production quotas. There are now no official production targets on behalf of the OPEC member countries. And so we're in, to all intents and purposes, notwithstanding the production freeze discussions we had just recently, in what you would describe as a free market for oil. Anybody who can produce oil and can sell oil does so. They find customers wherever they can at whatever price they're able to sell their oil at. So we're in a very, very interesting period. But our job when we sat down in January to begin drawing our conclusions about the main factors affecting the market out to 2021 was against that very, very turbulent backdrop. And amongst the key issues that we discussed and some of the key points that we've expanded on in our report are the following, as you can see. out to 2021, we expect that global oil demand growth is going to be fairly solid, unspectacular, at about 1.2 million barrels per day out to 2021. The reality, of course, is that it will not be such a smooth and steady progress as that, but it's likely to average a solid 1.2 million barrels a day through to 2021. The other issue that we're grappling with, and it's an ongoing story of trying to grapple with this, is that production growth around the world, particularly in the non-OPEC group of countries, has come to a halt, and indeed production is falling in the non-OPEC countries as the era of low prices and investment cutbacks are beginning to bite, and we're seeing actual falls in non-OPEC production. Perhaps unsurprisingly, because the Asian economies are the main growth areas as far as oil demand is concerned, we're seeing crude trade become even more oriented towards the east than it has been in the more recent years. Some of the uncertainties, I referred a moment ago to the OPEC production policy. Well, there isn't actually an OPEC production policy, but there might well be in years to come when the market if market circumstances change. The pattern of production from the non-OPEC countries, the higher cost producing areas, for example, US shale production, but also expensive projects in Brazil and Canada and elsewhere. Always, of course, we're wary of the underlying trends behind the World Economic Outlook. And since we published our report in February at a time of great uncertainty, we've seen institutions such as the International Monetary Fund put out forecasts which are perhaps rather on the gloomy or the negative side and are giving us pause for thought. Will the oil demand outlook that we're showing based on economic growth, will that prove to be reliable, and will it stand the test of time? And last and not least, as countries use more and more energy, and in particular oil, they're of course using it more efficiently, and we're finding that even in the developing countries where hitherto very, very fast rates of growth have led to relatively inefficient uses of oil, we're beginning to see efficiency improvements being embedded in legislation in China and in India and some of the other countries, and we've seen cutbacks in subsidies, for example, as well. So these are some of the issues that that we're talking about, but by no means all of them. And just moving through the outlook for world oil demand, in the 5 or 6 year period up to 2015, we saw an annual average growth rate of just under 2%, although within that average for the period as a whole, we saw some quite wild swings. In the aftermath of the global financial crisis in 2008, 2009, we actually saw demand fall, and then we saw a very sharp rebound in 2010, well over 3% growth. But overall, during that period, we saw 1.7% per year to 2015. And as we said at the very beginning, as we start to look out to 2021, in the period to 2021, we're seeing a much steadier, slower rate of about 1.2%. And part of that slowing down of the momentum as far as world oil demand is concerned is due to vehicle efficiency improvements, China's shift away from what has been hitherto a very oil intensive, heavy industry oriented pattern of growth, more towards the consumption of services and the wider growth of a consumption based economy in China, as more and more people move into what we call the middle class. And we've seen, or we are going to see in the period to 2021, vehicle efficiency improvements of something in the region of 2% every year, whereas in the period up to 2015, the efficiency improvements we were seeing in vehicle fleets was only just above 1%. The underlying GDP backdrop perhaps a little bit less supportive to 2021 than we saw up to 2015, but global GDP growth nonetheless is going to fall somewhere between 3.5% to 4% a year. And we've seen strong oil demand gains. While we've been talking about China slowing down a little bit, we're beginning to see improvements in demand growth in hitherto relatively neglected continents such as Africa and some other parts of the Asian region, again with fast rising populations, GDP growth beginning to pick up, their economies becoming more dynamic. The oil demand gains in regions such as Africa are going to become perhaps rather more of a factor in the next few years than they've been hitherto. But as the graph shows, what we have is unsurprisingly Asia-Pacific, the Asia-Pacific region as a whole being the main engine of demand growth out to 2021, as of course it has been in the last 5 or 6 years as well. So within the global picture for oil, we have China. For the last 15, 20 years or so, growth in China has been very, very rapid indeed. And in some years, particularly in the early part of this century, we were seeing growth rates of 8 towards 10%. But what we're beginning to see, as we said a second ago, is a change gradually in the economic structure in China away from the heavy energy-intensive industries, and the rise of the middle class is meaning more and more emphasis in the economy on services and on domestic consumption. That is a big change in China, which is something that is going to impact on the patterns of oil demand growth very severely over the next few years. We're going to see a big increase in vehicle populations, personal vehicles, passenger vehicles, and as we said, there is a shift away from heavy industry more towards services. On the other hand, the OECD region, which IEA is part of the OECD, so we're mandated to discuss the market in terms of OECD and non-OECD. In 2015, the OECD group of countries, which traditionally have been relatively low growth areas as far as oil demand is concerned, did see a growth spurt in 2015 on the back of much lower prices. Prices fell dramatically from the beginning of from the middle of 2014 onwards, all the way through 2015, and even in Europe, which is a relatively stable oil market, very mature oil market, we saw a little bit of growth. But that is essentially a one-off, and the longer-term pattern that we've been used to will be asserting itself in 2016 and beyond. It's often forgotten that in Europe and indeed in the United States, oil demand peaked about 10 years ago. The peak year for oil demand in the United States, in Germany and France, I think the UK also, was 2005. And in Japan, the peak year was even earlier than that. So to see a growth spurt in 2015 was a rare phenomenon, rather like Halley's Comet. It doesn't come around very often. In the United States, which of course remains the biggest oil market in the world, just below 20 million barrels a day of oil products are used in the United States. We've given the slide a rather vivid title, Rampant US Gains, Ease Then Reverse. What we did see in the United States is that year-on-year growth was very strong in 2014-15 as prices fell dramatically at the pump. The US is a relatively lowly taxed energy economy as far as oil products are concerned. Consumers are very price responsive, and demand for gasoline in particular grew quite sharply. But the 2015, or towards the end of 2015, we began to see the price effect wear off. There's only so many miles you can drive, only so many miles you can fly. And in 2016, we're seeing a much slower rate of growth in the United States. And the early indications that we have from some of the data which is feeding through is that the US could end up in 2016 being fairly flat as far as oil demand is concerned. But gasoline still remains obviously an important part of the market. The US gasoline market at 9 million barrels a day is by far the biggest single product market anywhere in the world. OECD Asia, not going to dwell on that too much because that's essentially Japan and South Korea. But the longer term declines that we're seeing, the structural declines in Japan and to a lesser extent in South Korea, will continue throughout the period to 2021. We're going to see a reduction in the amount of oil, for example, that's burned in Japanese power stations. But Japan has been in long-term gradual decline as far as oil demand is concerned since it peaked 25 years or so ago. But of more interest than the OECD Asian countries, or indeed even than Europe, where we're expecting the long-term decline to reassert itself out to 2021. And I'll skip through this slide because it's of far less interest than what we're seeing here, which is the takeover in the global oil demand structure of the non-OECD countries. We saw in about, I think, 2012, 2013, the non-OECD, the so-called developing world, overtake the OECD countries in terms of total oil demand. They overtook the non-OECD countries. That's a major historic shift that was inevitable. It's because non-OECD have been growing very, very fast for a very, very long time now. But we have finally seen the non-OECD countries overtake OECD. It doesn't happen yet as far as gasoline is concerned, for a bit later, but total products, the non-OECD has taken over. Now, India, we're very interested in what's going on in India because it's a huge country, of course. It has a growing population, and it looks as if India is beginning to take off. Now, we say that in reference to what happened in China just over 10 years or so ago, maybe 15 years or so ago now, where Chinese oil demand growth really took off in the early years of this century, and we were seeing annual average growth rates of 7.5%, 8%, and occasionally even higher than that. And 2004 is often cited as the big kickoff year for China, where there was a huge growth spurt. And India could be on the verge of something quite similar. The very, very early indications from the data we have for 2016 and some of the revised data for 2015 is that year-on-year products demand in India looks to be 8-9%. Very early days, it may not turn out to be maintained, but we think India is on the verge of moving ahead very, very fast indeed. And in 2016, if the rosy picture for India does turn out to be accurate, and if China's rate of demand growth is lower than we've been used to in recent years, we could see that in 2016, India's volume increase in demand could exceed China's, which would be the first time that that's ever happened. But of course, India still has an enormous amount of development still to do, and even today, after many, many years of very rapid oil demand growth in China, we still have I think it's a vehicle ownership level per 1,000 drivers, I think is the criteria we normally use, of something like 100 vehicles per 1,000 people of the driving age population. 100 in China. The United States at the very extreme end is 800 cars per 1,000. In Western Europe, the average is somewhere between 400, 500, something like that. So China, even after all these years of development, is still only 100 cars per 1,000. India today has just below 20 cars per 1,000 of the driving population. And clearly, India has enormous scope for development, but the middle class is growing. I've been lucky enough to visit India, and I'm sure many other people here have had the opportunity as well, and you can see it. Each visit you make, you see new roads are being constructed, new infrastructure, so there's an enormous growth surge likely in India in the next few years. Now, switching perhaps rather abruptly from one or two issues on the demand side to supply, and in some respects supply, certainly as far as today's oil market outlook is concerned and the outlook for the next 5 years or so, perhaps supply is even more interesting than what's happening in demand, because overall demand is a fairly solid picture, at least that's what we think it's going to be. But as far as supply is concerned, we at the IEA have been putting out a message fairly consistently in recent months. Our executive director has made these remarks publicly many times about the dangers of the big cutbacks that we're seeing in upstream oil capital expenditure. In 2015, as it says on the slide, we saw upstream capex cut by round about 24%. It's a slightly moving target, but there's no doubt that there was a major cutback in upstream capital expenditure in the oil sector in 2015. And so far, from what we've been able to glean from the company announcements and other sources of information, it looks as if we'll get close to another 20% fall in 2016. Again, that's also a moving target because the companies regularly update us on their numbers. But the tendency is likely, if we change the 2016 number, for that 17% figure to be increased rather than decreased. Looking ahead to 2017, we can't be sure at this very early stage what the companies will do, but it's highly unlikely we're going to see a big rebound in investment in 2017. The point we're making here, and the very, very important point we make, is that we need continuous investment in the oil sector, both to maintain existing production levels in many countries around the world where continuous investment is needed to maintain production, but also to bring on stream the new projects that are going to be necessary to meet the 1.2% per year increase in oil demand that we expect. And at the moment, there are signs that there is going to be possibly insufficient investment in the next 2015, 16, 17 period, so that were there to be a faster rate of demand growth than we currently expect, perhaps allied with geopolitical problems which might remove significant production from a part of the world, we might suddenly find there's a scramble for supply. And the consequences of that have been in the past that we've seen a very, very sharp and rapid increase in oil prices to levels which are not comfortable for the global economy. So this is a warning, if you like, that the very, very high levels or rather the big falls in upstream capital expenditure that we're seeing at the moment, they are a danger sign for the future. Meanwhile, what we've seen in the supply side of the balance in the last year or so is that world supply growth has plunged, and there are several facets to this. As the slide shows, the pale blue column that you can see shows that in 2014 and indeed in 2015 we saw a big increase in oil production from the non-OPEC group of countries, led mainly by the United States, but also Canada, Brazil, and one or two other countries around the world, but led mainly by the United States. And in some respects, the graph doesn't perhaps do full justice to the increase we've seen from the United States, because back in 2008, crude oil production in the US was 5 million barrels a day. By the middle of 2015, which was the most recent peak, that 5 million barrels a day had increased to 9.5 million barrels a day, most of that attributed to what is colloquially called shale oil, but also some growth from the offshore Gulf of Mexico, the deep water production areas in the Gulf of Mexico. And 2014 was a big year. 2015 was also a big year because shale oil continued to grow, and one or two other non-OPEC countries continued to grow also. But in 2015, what we also saw, and this is the dark part of the column for 2015, is a big increase from the OPEC countries, and particularly a big increase in production from Iraq, which is a phenomenon that has been predicted for many, many years, but it finally came to pass in 2015. But we also had increases in production from Saudi Arabia, because as a consequence of the decision taken at the end of 2014 to pursue market share rather than to cut production to support prices, we saw Saudi Arabia and other producers move aggressively to ensure that it was their barrels which were supplying the big increase in oil demand. We had a big increase in oil demand in 2015 of 1.8 million barrels a day, one of the biggest increases we've seen for some time. So the producers were pumping out the barrels to try to meet that demand. As we move into 2016, what we're beginning to see, and is clearly visible, is that the non-OPEC production total figure is declining. and we'll come on to that in a bit more detail in a moment or two, but it's declining heavily. And we think that non-OPEC crude production in 2016 will decline by the biggest amount we've seen in any year since 1992. So this is a pretty significant development. We've had gradual increases over the last 20 years or so, with the occasional fallback for non-OPEC production, but 2016 is going to be the biggest decline in non-OPEC production we've seen since 1992. And as we move forward through the forecast out to 2021, after the fall in 2016, a further fall which isn't perhaps quite visible for 2017, the non-OPEC production will begin to rebound as prices have bottomed out and have stabilized, and as prices begin to rise on the basis of a market structure which we'll come on to towards the end. So non-OPEC will begin to recover. I'll skip through one or two of the slides because this is a big slide pack which is available to everybody after the meeting, and you're very welcome to look at it in more detail. But I'll focus on some of the more interesting specific points. And shale oil production in the United States is always the big issue which analysts, whether it be in the IEA or elsewhere, are challenged about. And as far as US shale is concerned, what we're looking at the moment is that in 2016, production will fall by about 600,000 barrels a day versus 2015. And in 2017, we're expecting a further 200,000 barrel a day fall in the US light tight oil regions. There's been an enormous drop in the rig count since October 2014, when the rig count reached its highest peak. The rig count has fallen by well over 70%, close to 80%, and even though there have been enormous productivity improvements in the US shale province over that period, and there are still an enormous number of uncompleted wells, we still believe that the light tight oil production in the United States is finally beginning to fall because lower prices for longer are, if you like, the straw that has broken the camel's back. When oil prices did start to fall in the second half of 2014 and continued throughout 2015 as each milestone was reached, when oil got to $90 or $80 or $70 and so on and so forth, it was very fashionable for analysts and for the media to say, at last, this is the price which is going to destroy the US shale industry. But we all, I believe, underestimated both the technical resilience of the people working in the shale provinces, their ability to find better ways of improving their process technology, the efficiency of their operations, their ability, at least in the early days, to refinance, the fact that many of them had hedged their production at relatively high prices meant that they stayed in the game for far longer than most of us realized. But as the price has gone down through 50, through 40, down to 30, albeit a rebound more recently, we are now beginning to see clear signs of a major exit from the sector. And we'll just have to wait and see as 2016 progresses if that expectation turns out to be accurate. It's been resilient up till now, and maybe the US sector will still surprise us, who knows. But at the moment we expect a major fallback from the ranks of the US shale producers. Elsewhere in the US, it's often overlooked, and it's worth perhaps pointing out that the Gulf of Mexico, the deep water projects in the Gulf of Mexico, having of course had a major setback with the Macondo disaster in 2010, we're now beginning to see projects which have been in the pipeline, so to speak, for several years are now coming on stream and are delivering fairly considerable volumes. And the Gulf of Mexico is going to increase fairly sharply as each year progresses through our forecast period to 2021. Total supply from the United States, following the fallback that we're seeing for shale producers in 2016 and 2017, we see a rebound from 2018 onwards, and that rebound, allied to growth in other parts of the US, such as the Gulf of Mexico, means that by 2021, US supply will be at a record level crude and NGLs of about 14 million barrels a day in 2021. That's a big increase, but that is dependent, of course, on the path of oil prices that we do see, and the ability of higher cost producers to have cut their costs in the meantime, to be able to either resume operations or expand operations that they've had to put on hold in the past couple of years or so. In the global context of the non-OPEC group of countries, the United States, as we describe it here as the growth engine, you can see on the very left of the chart that the United States stands almost head and shoulders above everybody else in terms of the gains that we're expecting to see to 2021. But it's not just the US. We're expecting fairly strong gains in Brazil and in Canada, Australia to some extent. On the other side of the balance, the countries that we think are likely to see lower production over that period, the biggest of them all is Russia, although we are experiencing a little bit of doubt about that at the moment, but currently expecting Russia to fall back. The long-term decline in the North Sea countries, Norway and the United Kingdom, that will resume, even though they've had a little bit of a growth spurt just recently. But the United States is going to be the main player amongst the ranks of the non-OPEC countries. Canada, as we said a second ago, Canadian oil sands will continue to increase. There's been some very, very interesting developments in terms of cost reductions in Canada, projects which were previously thought to require $100 a barrel for the full cycle are now considered to be more viable, closer to 70 or to 60 because of the improvements in efficiency that they're achieving, the technology improvements. So Canada is going to be one area of growth to put alongside that of the United States. Brazil, despite what we rather kindly call challenges in Brazil, I suppose the collapsing government and the clouds that exist around Petrobras are probably going to be very important in the next few years. Brazil is still likely to expand despite the challenges, simply because there's been so much investment in recent years in projects that are now beginning to come on stream. And the momentum, if you like, that has been provided by that investment over the last few years will remain strong, and we're expecting to see Brazil expand. The North Sea, I said, had a temporary recovery. The North Sea, in many respects, is a province that is almost, certainly the UK part of the North Sea, is almost a function of whatever level of tax the British government decides to levy on existing projects and indeed on the development of new projects. And in the last few years, there's been various tax breaks offered to companies in the UK sector. And we've seen in recent years a little bit of a modest growth spurt in the North Sea. But in the long run, the long-term decline that we expect for the sector is going to continue. Russia, resilience is the way we've described it. It's such a huge producer, well over 11 million barrels a day currently, but we are expecting a fallback over the next few years, partly as a result of a lack of investments and certainly a lack of foreign investment in the sector because of the maintenance of sanctions. But even if Russia does fall back over the period, it's still going to remain a very big and a very, very significant producer. After the lifting of some of the sanctions against Iran, not all of the sanctions have, of course, been taken off of Iran. We're expecting Iran to be the biggest single growth area within the ranks of the OPEC countries. Previously, as I said much earlier on, we saw a big growth spurt from Iraq in 2015, but there are problems there. There are obviously security issues. There are also issues over the stability of the government. There are arguments between the central government and the Kurdistan area in the north, and there are technical challenges of maintaining the growth that we did see in Iraq. So Iraq will not be such a big factor, but Iran, subject to Iran being able to attract investment, and it needs to establish a coherent and attractive investment climate before that happens, but subject to investment coming into Iran, Iran is in a very, very good position to increase its oil production quite sharply in the next few years. The current milestone that it's aiming for is to get its production back up to the just below 4 million barrels a day that it had achieved before sanctions were imposed. But as a historical note, and I'm not suggesting this might happen, But in the period just before the Iranian Revolution in 1979, Iran was producing round about 6 million barrels a day. And given the size of its reserves base, technically you would assume that that could well be possible, although the investment climate may not be attractive enough for that to be achievable. But that's a historical note which gives just a little bit of context about Iran. Unsurprisingly, perhaps the Middle East is going to dominate growth within the OPEC group of countries, partly because that is where the majority of the investment and the activity will be, but also in other parts of the OPEC family. There are huge problems. Of course, Libya is a special case all by itself, and Libya is to some extent almost unforecastable. But other countries within the OPEC family, such as Venezuela, Nigeria, Algeria, which have considerable potential, but for one reason or another are not realizing that potential, we see very little change or very little sign of improvement in those countries, Venezuela, Nigeria, Algeria, possibly Angola too. And as I said, Libya is off to the side for the time being. So the Middle East will dominate the growth in production that we expect to see from OPEC as a whole. And the Middle East, of course, which is probably not news at all, is going to dominate oil exports. There's a very large dark blue blob located over the Middle Eastern region, and as you can see, as the arrows spread out from the Middle East, heading predominantly east. They're heading predominantly to the growth markets of Asia, China and India, and the other developing countries of the Asian region. And perhaps also, unsurprisingly, I don't quite know how it does that, but it does it, and eventually it stops. The crude trade shifting eastwards. We're seeing the volume shown there that we're expecting to move to China and to India. The red numbers in the brackets, which are perhaps a little difficult to see from a distance, but you'll be able to look at it when you have the slide pack, show that the actual growth we're expecting in the period to 2021 for those trade routes. But crude trade will shift inexorably eastwards because that is where the demand growth is. The Middle East increasing its export share, that's perhaps a slightly luxurious extra chart we don't really need, having described the dominance of the Middle East within the OPEC countries and how it's increasing its exports. We'll go to China in particular, because Chinese imports, even though the rate of demand growth in China is going to be lower than we've seen over the last 10 or 20 years or so, we're still going to see a big increase in exports to China, up to 8.5 million barrels a day, with those Middle Eastern countries being at the forefront of that increase in trade. One final point which may be of interest to people in this audience, although sitting in the dead center of Spain, about as far away from the coast as you can possibly get, talking about marine fuels is perhaps not the most relevant subject, but of course we are interested in it. And of course the tighter marine fuel standards that we're expecting around the world, or that have been mandated around the world for the next few years, are going to see a big switch away from fuel oil in shipping to gas oil. And that will happen around about 2018, 2019 onwards. That slide perhaps belongs a little earlier in the pack, but it's an important point nonetheless, and it's going to make a big difference to the product market balance over the next few years. Now, moving to what we describe as perhaps the key slide, because it dictates where we think the market is going to go over the next few years, and this is perhaps our most important closing point. I'll just back up slightly, because this is a graph which comes along in installments. As you can see, we've had in the last few years global supply, which is the blue line, considerably in excess of global demand through 2014, 2015, and through 2016 as well. We've seen a surplus of supply over demand of at least 1 million barrels per day for each of these 3 years. But as we move forward, we're beginning to see signs that the market is rebalancing. And as we move through the forecast period, we should see the supply surplus be eliminated and we begin to see stocks draw down as demand is in excess of supply. Now, as we build this up, what we're seeing in our what we call our base case is that, as I said a second ago, big increases in stocks in 2014, 15, 16. In 2017, it shows a tiny increase in 2017 as well, but that number's changed ever so slightly, so you're going to see a fairly flat picture. But as we go through 2018, 19, 20, through to 2021, stocks begin to draw on our base case. That's assuming the oil demand forecast we have remains valid, and it assumes that the fall off in non-OPEC supply that we're forecasting currently, primarily in the US but also elsewhere, that forecast also remains valid. Because if it doesn't remain valid, what we will see, in other words, if the United States oil production, for example, does not fall by the levels that we're currently forecasting, we see a much bigger stock build in 2016 than we're already going to have. And in 2017, we still see the maintenance of a substantial stock build in that year before the market rebalances and starts to draw from 2018 onwards. But if, for the sake of argument, US oil production and indeed other high-cost production were to fall by more than we're forecasting this year, and we did a little bit of work to try to understand what that might look like, then what we're going to see, as you might expect, is a smaller stock build this year, but then a fairly significant stock draw in 2017, 18, 19, 20, and so on and so forth. Now, whichever one of those three scenarios comes to pass will obviously dictate the pace at which oil prices begin to recover. And at the moment, in our monthly oil market report, which we put out in the middle of each month, and of course we've done 2 of those monthly reports since we published the medium-term report, what we're beginning to see is that, tentatively at least, the non-OPEC supply cuts that we forecast do look to be happening, and our demand growth number does look to be firm and robust. So on that basis, we currently expect that by the end of 2016, and this could be in the fourth quarter, we think the market may move to balance at that time. But if not in the later part of 2016, at the very end, almost certainly in the early part of 2017. We still have work to do on this. We're not wholly definitive as yet, but it's clear that the direction of travel for the oil market at the moment is towards balancing, and it's just a matter of time when it actually happens, but it is beginning to happen. And that, of course, will have an impact on the level of oil prices. Now, I know I won't be able to get away without expressing a view on oil prices, although the IEA does not specifically forecast prices month by month, year by year. But at the moment, on the basis that the market returns to balance, and on the basis that we do see regular stock draws from 2017 or 18 onwards, then we're looking, and indeed when we were doing our supply work analysis and looking at our demand numbers, we were working off an expectation of crude oil prices at about $80 a barrel in 2020, with a gradual run up towards 80 from where we are today. So that remains to be seen whether that is accurate. In the meantime, very quickly, the key points that we've discussed today, and there's an awful lot more that we could have said. Global oil supply growth is plunging. It's going down. The low oil prices are gradually having an impact. Iran is going to be a big gainer over the next few years from within the ranks of the OPEC countries. US will recover gradually after the troubles of 2016 and 17. Oil demand is finally going to go through the historic and symbolic probably level of 100 million barrels a day, 2018, 2019, something like that. But the point we do make here is that, as it's described, the availability of resources that can be easily and quickly tapped will limit the scope of price rallies. That's perhaps a rather clumsy way of saying that as prices do begin to recover, and some of the higher cost producers are able to return to the market at a lower cost level than was the case before they exited it, that return by higher cost producers alongside the enormous level of oil stocks that have been accumulated in the last few years, those factors will place a cap on the likely levels of oil price rises, certainly in the near term. Further out, rather more difficult to say, of course. And finally, and certainly not the least important point, which we like to emphasize, is that the investment cuts that we're seeing in the upstream sector of the oil industry, the big 24% fall in 2015, again close to 20% in 2016, that potentially stores up trouble for the future if market conditions were to lead to very tight markets. I'll finish on that note. As I said, there is an enormous amount of work in the report, which I hope you may get the opportunity to see at some point in the future. You will receive a copy of these slides, and you're very welcome to ask any questions that you have, especially, of course, easy questions. They're my favorite questions of all.
Okay. Thank you very much, Neil, for coming here, and you are open to the presentation. You have said now, and you can download these slides from our web, and you can buy the report from the IEA. Okay, he's open. Please go ahead. If you would like some word, maybe about the prices. Here you have Nuno. You can present yourself. Isabel, you can give the micro to Nuno.
Gracias. Well, thank you very much for the presentation, very clear. Well, my name is Nuno Moreira da Cruz from GOP. I know that we are talking about the medium-term market report. It's only for the next 5 years. But it's within the next 5 years that most of the companies will be deciding whether to invest or not. And I'm sure around the world, in oil companies' boards at this stage, the decision is about whether should I invest 100, 500, $1 billion to get to crude, which I'm not sure will be needed by the time I leave it. So I would like to see the view of the agency in terms of trying to advise these companies. How do you see, when we talk about India having 20 cars per 1,000, it will go to 100 and to 200. The question is whether their cars will be using the same source of energy. Yeah, and so the question is about that. I mean, how do you see, what's the view of the agency in terms of forecasting the use of oil in the 2030, 2040?
Well, in the much longer term, yes, there will be challenges to oil, and you could argue that some of the measures that the Saudi Arabians are taking at the moment are taken with an eye on that eventuality. But we still expect to see global oil demand to grow for the next 20 years, simply because of the pent-up demand in developing countries such as India and China. Yes, there will be penetration by alternative fuel vehicles, that's certainly true, but not in the next 10 years and probably beyond that for 20 years, because there is not as yet a mass market solution to the fact that oil still retains something like an 80 to 85% role or share in the transportation sector. And until there is a mass market solution to that situation, then we expect demand for fuels to continue to increase. Now, of course, that comes back to the challenges of investment. Well, certainly for the next 10-year period, there is absolutely no danger to oil investments whatsoever. There is not going to be a major change in the demand structure. I think the biggest challenge for some of the major international companies today is not so much necessarily whether they're cutting back on investment this year or next. Well, it is an issue for today, but also the issue about the balance between rewarding their shareholders and being able to make investments today at lower costs, which are going to come to fruition in 3, 4, 5 years' time, and will enable them to capture growing markets in those parts of the world where demand is growing. And there's a challenge which is being placed in front of many of the big international oil companies about the sanctity of their dividend policy. And is that necessarily the right strategy to maintain in the next few years? But coming back more directly to the issue, I don't believe that in the next 20-year period that we're going to see a significant change to oil demand patterns. It will continue to increase, and until there is a mass market solution to the transport issue, that will remain the case. Further out, yes, indeed, there will be a change, and peak oil demand will come long before peak oil supply.
More questions for Neil? Maybe something surprised that the States will remain the main producer in the 2021.
Who, sorry?
US.
Oh,
US.
yes. Well, yes, but it's all a question of the dynamism of the industry and the fact that I think our colleague, the chief economist of BP, described the US shale phenomenon as being perhaps one of the closest things we've seen to a manufacturing process in the oil sector, and the fact that it is very dynamic and very, very flexible. What's been very interesting over the last few years, and this will perhaps hold a lesson for the analysis we try to make over the next 10 years or so, is that, and maybe we're arguing against our own ability as forecasters here, but anyway, pretty well every analyst failed to appreciate the pace of growth in the US shale sector after 2008. It took most people by surprise. If you go back to forecasts published at that time, you will not see people telling you that US crude production would reach 9.5 million barrels a day. So we got that wrong, largely speaking, as a group of analysts. The other factor that we're struggling to understand, and not that we're necessarily getting it wrong, but we're struggling to understand it, is the full extent of the fallback in US production in the wake of lower prices. And as I said earlier on, when the price went below 100 to 90 to 80 to 70, at that point everybody was waving their finger and saying this is going to be big trouble for the US shale producers. They'll have to shut in their operations. Again, we underestimated their tenacity and their ability to improvise and their ability to improve their efficiency. So we're finding it difficult to understand that. We think we understand it, but we can't be completely sure. The third part of this, production having gone up, the production having gone down, is when the production rebounds again, trying to understand that, because as far as US shale is concerned, we haven't been here before. This is a new phenomenon, it's a new industry. There's not much to compare it with. And the rebound, when it does come, is going to be very, very difficult to call. But there will be a rebound, but calling the extent of it is very, very hard. But at the moment, our view is that on the basis that there will be plenty of investment available in the US after the travails of 2016 and 2017, US will resume its growth and it will get back to record levels by 2021. In the meantime, of course, there'll be developments elsewhere, and in Canada and Brazil, and maybe Russia will be free of sanctions. Perhaps that's a very big call to make. But there are parts of the world that may also grow. So again, what's the fascinating point to make from the vantage point of 2016 is that when I was working consulting 10 years ago, 2006, 2005, we were producing graphs, pretty well everybody else was, talking about peak oil supply, which was supposed to be taking place or coming to fruition round about now, 2016, 2017, 2018, after which time production would begin to fall gradually. Of course, what we're now seeing is that production rises inexorably year upon year upon year, and we're expecting that to continue for the foreseeable future. So as I said a second ago, we'll see peak oil demand before we see peak oil supply.
Okay, some more question. You can comment something more about Venezuela. You are an expert over there, no? You were working there for 15 years.
I find it very hard to talk about Venezuela for any length of time before tears begin to fall down my face. I worked for Petroleos de Venezuela for a very long time, based in their London office, and I was very fortunate to work for the company at a time when It was a very, very well-run state oil company. It wasn't carrying excessive numbers of workers on the payroll, and it was investing or planning to invest in a lot of very exciting projects, not just in conventional crude, but in unconventionals, and to some extent there were plans to invest in LNG and many, many other projects. And the idea back in the 90s, the mid-90s, was that Venezuela, it just shows you how inaccurate our long-term forecasts are. In Venezuela, they would, the idea was that they would increase production to 5.5, maybe even 6 million barrels a day, but certainly a much bigger number than it is today, and be the principal reliable supplier to the United States. Because if you look at a map, Venezuela is pretty close to the United States, the Middle East is way off over there somewhere. The United States would be the key market for Venezuela. It would be a reliable long-term supplier, not just of crude, but also via its own refineries in the United States, which PDVSA owned and still does own. It would also be a supplier of products as well. Of course, that vision has turned to dust in the last few years because, unfortunately, the government has decided to not allow Petroleos de Venezuela to keep much of the proceeds of its oil sales in recent years, even though oil prices have been very high for very long. So the company has not been able to invest, so production has been gradually declining year on year. And rather than producing over 5 million barrels a day today, or 5.5 million barrels a day, which was the vision back then, Venezuela is struggling to produce more than about 2.3 million barrels a day. And that is a great tragedy. There's a waste of potential and perhaps a lost opportunity. But eventually things change because there are major problems in the economy as a whole in Venezuela, and we're seeing political challenges to the government by constitutional means, and there could be a change in the environment in Venezuela, but I don't think it's likely to happen very soon, unfortunately.
Okay. One question over there. You have the micro.
Carlos Olivares from FEPSA. Well, I have a question about bunker and IMO legislation. I would like to know which is your view. I have seen the presentation that there is an increase in gas oil demand from the year 2020. But then about that issue, I would like to know what do you think about when is it going to take place, 2020, 2025, and who is going to move first, ship owners or refineries, and which is going to be, from your point of view, the evolution of that matter?
Well, it's at this point where, in that quiz show, I can't remember the name of it, where you're allowed to phone a friend who can give you the answer. I can't give you a very detailed response on that because it's not my main area of speciality, except to say that the challenge to the refining industry is very profound because it requires reconfiguration in some parts of the world. Having said that, there's been a lot of investment in many regions of the world in refining over the last 10 years, which have been maximizing diesel output. That was regarded as the next big thing. We should maximize diesel. So, and of course, there are large availabilities of diesel from some of the Asian refineries and the Middle Eastern refineries as well. Less so in Europe, I think. But I'm not able to give you an answer that can tell you definitively a view on how ready the refining sector is for this. I just don't know. What I am able to say is that what we have seen with some of these major specification changes in the past is that they become a bit of a moving target because in this case the ship owners and or the refiners are just not ready. And the shipping industry, or parts of the shipping industry, have had difficult times in recent years, not necessarily oil tankers, of course, because there's been a boom in maritime movements of oil. But we're seeing a slowdown in the rate of growth of global trade, which implies a weaker outlook for the maritime sector. So it may well be that partly because of the macroeconomics, but also because of the technical and industrial factors, that the precise point at which this takeoff does happen may be moved back, but I'm not really too sure about that.
Thank you.
Go here? Okay.
Here.
It's Victor Bedegain from EDP. You mentioned Algeria as not realizing its supply growth potential. I don't know if you could say something else about that. I mean, why it's not going to realize its growth in its potential growth?
Yeah, no, I take the point. Now, what we did some work looking at, if you like, the OPEC member countries that are in difficulty in some way, shape, or form. Venezuela, Nigeria, and in the case of Algeria, it's the inability of the government to attract investment at the levels that they desire. There have been various false starts in recent years. The inability to get a clear investment outlook and a clear investment structure, which is leading to Algeria arguably underperforming. I'm not an expert on the Algerian political situation and whether there's going to be another round or there'll be another attempt to come up with something rather more attractive to foreign investment. But Algeria is amongst that group of countries which is seeing its output stagnant, if not actually declining, when the potential exists for it actually to increase. So I'm not able to say much more than that, but it's all a question of investment climate and the ability to bring in foreign capital and foreign expertise. Because although the international oil companies are having maybe some difficulties at the moment, they still have the need to invest for the long term. They have to replace their production as it declines in some parts of the world, and they're shut out of Russia for the time being, largely. Venezuela is a bad case also, as we described a moment ago. Nigeria is having difficulty. Shell have been doing their best to exit Nigeria. And we see problems in some other countries as well. So if there are places in the world which should be attractive, Iran is perhaps the best example of all, and places also like Algeria, then you would think that the investment climate would be made as attractive as possible. But so far it hasn't. And Algeria is on that list with Venezuela, Nigeria, Algeria, to some extent Angola, but less so, where perhaps they're not seeing as much investment and as much production growth as you might, as perhaps should happen.
Okay. So we'll the first row.
Thanks a lot, Neil, for the presentation. I'm Luis Aires from BP. I think some of the messages are very, very clear, like there's plenty of oil, the issue is not on supply, there's growth in demand in the non-OECD countries. I wanted to talk to you about regulation. So how do you see governments and future regulation coming into the sector, particularly in the light of sustainability, the agreements after Paris? How do you see the evolvement of regulation in our sector, and what could be the potential impacts, particularly on the demand side?
Well, as far as environmental issues concerned, the IEA is doing these days an increasing amount of work focused on what let's call it the low carbon agenda. But as far as the oil market is concerned, in some respects, repeating what I said earlier on, there's not going to be a major change to the overall structure of the oil market for the next 10 or 20 years or so. Demand will continue to grow. However, what we are likely to see, which is I think what you're getting at, is regulatory changes, like, for example, the place of diesel in the transport fleet. Back in the UK, before I moved to France at the beginning of the year, there was a growing debate, and in fact it's continued since then, about measures to limit and indeed, if not eliminate, diesel from certainly from the passenger vehicle fleet. Rather more difficult when you're getting into trucking and some of the other uses. But there is clearly going to be a major regulatory push in that respect, and I think the political momentum behind that is growing and will probably be unstoppable. So that is going to be a major issue which the industry is going to have to deal with. What do you do with all this diesel that is being made? And on the basis that we will continue to see liquid fuels powering the vehicle sector for a considerable period of time to come, moves back to gasoline, which in itself is going to obviously be subject to tighter controls because the big issue of urban pollution is rising. This year in the IEA's World Energy Outlook, which it publishes every year, the big thick book which you have in your office, a whole library of them. They're putting out an interim report, my World Energy Outlook colleagues, for the first time on urban air quality. It's the first time they've ever looked at this issue in some depth, and one of the issues, or a big part of that issue that they're tackling, is the use of traditional fuels in transport and its impact on the air quality in the urban areas, and some proposals to see how we move away from that. But it's going to be a mix. You can expand the concept of regulation away from purely the fuels themselves and the quality of the fuels to issues such as congestion charging in cities, which we already have in London, and is likely to become more prevalent elsewhere around not just Europe but elsewhere, which will impact the growth in demand for transport fuels. So there's a whole lot of issues out there, but overall most of those regulatory issues are likely to be first world problems, because in the developing countries, which is not to say they don't take air quality seriously, because they are starting to do that, and not to say that they don't take producing higher spec products seriously, but the sheer growth in the numbers of people taking to the roads in developing countries, the sheer growth in commerce as goods and services are moved around the economy, the possibility that the growth in those countries overwhelming the, if you like, beneficial measures that are taken elsewhere in the world, that's an extremely interesting point. And as far as the oil market is concerned, we don't see any major impact from the COP21 talks in Paris, certainly on the structure of the oil market for some years to come. And it was not a factor when we were putting together the medium-term report at the beginning of this year.
Okay, some more questions? Oh, okay, thank you, Neil, for coming. It's a pleasure to be here. We will see you next year here to present the next year report.
I hope so. Thank you very much.
Thank you very much. Muchas gracias a todos.